Now, scale at all costs. Well, we're not in Kansas anymore, are we? You know, it's not 2021, whereas the markets are nuts and Bitcoin is going crazy. We are in 2023, so we're in a different place right now. So how do you scale SaaS? We've got to be talking about this. So the markets are changing, so but we've got to keep going, as we've just heard from Catherine and her panel. So the best way of talking about this is to get some fantastic experts on now. Jill Chase from CapitalG and Guillermo Rauch from Versel to talk about the tactics they think that SaaS startups should use today to keep growing, right? And the ones that they should avoid. And to curate this wonderful conversation is going to be our very own, not Ron Burgundy, but Ron Miller from TechCrunch. Give them a round of applause, everybody.
Afternoon, everybody. Thank you for coming to the 4 o'clock session. There's a good number of people out there. I'm really happy about it. We were having a fabulous conversation backstage about this, and I'm pretty sure you're in for a treat when we get into this. We're here to talk about transformation from growth to profitability and efficiency. And it's something that seemed to happen like with the snap of your fingers in 2022. It was as though a switch flipped and suddenly it wasn't growth at all costs anymore. It was suddenly, that you had to be efficient and you had to be profitable. And I mean, it had to be kind of like mind-boggling for founders, but also for investors and how they deal with those founders. So the messaging just simply transformed, and we're going to talk about what that meant and how that affected each of the parties up on the stage. So, Jill, how did the way you communicate with startups change once this switch happened, and how long, like, what was the time horizon where you started to realize the economic conditions were changing and I need to think about this differently?
Yeah, for sure. Well, hey, everyone. Thanks for coming. I'll quickly introduce myself. And first of all, I'm a little thrown off. I thought this was getting moderated by Ron Burgundy, but I guess not. So I just have to quickly address. I'm Jill Chase. I'm a partner at CapitalG, which is Alphabet's independent growth fund. So I'm a growth investor who looks at mostly sort of Series B through IPO companies. And the reason I mention that is because it's quite relevant as it relates to how I advise and interact with the startups in our portfolio. Obviously the market conditions have changed quite dramatically from sort of the 2020, 2021 timeframe into sort of the 2022, 2023 timeframe. It all sort of starts with, we always are looking at what's happening in public markets because we're sort of advising our companies as they move towards IPO. And so when public market software multiples are quite high, you might think sort of the private market multiples for investing in the private round, Series B, C, D, should also be high because you can sort of justify that type of valuation. When public market multiples are lower, as they are sort of in this market environment, given interest rates, you might start to look back at the private market multiples and readjust that way. And so what we've seen over the past year and a half is this correction, because we've seen in the public markets, the multiples go down and the corrections happen in the private markets correspondingly. And so how that interacts with the way that we chat with and advise our portfolio companies is, because we have this long-term time horizon towards IPO, we've always worked with our portfolio founders to really think through investing efficiently, because we know you're going to have to defend it in IPO markets, et cetera, over time. And so really making sure you're keeping a keen eye on sales and marketing and having efficient unit economics at that time, and keeping a keen eye on R&D and making sure that you're spending appropriately to build a tech moat is quite important. Nothing's really changed over the time horizon in what we've been talking with our founders.
But the economic conditions changed. So how did that, you had to start talking to them kind of in a different language instead of saying, now grow, grow, grow. Now you have to sort of start like tempering the growth, but not too much, so how does that work?
Well, I think it's important to keep in mind that when the macro environment in 2020 and 2021 was such that capital was easier to come by, If you're a startup founder, it's rational to then spend that capital towards sales and marketing and building a distribution moat, because that's the way that you can differentiate yourself. And so spending quite a bit on sales and marketing is a rational play because capital is easier to come by. Same thing for R&D. It makes sense to spend quite a bit of money on R&D in that market environment because, again, building a tech moat is a way to differentiate yourself. With the macro environment changing the way that it has, capital is not quite as easy to come by. And so actually sort of thinking through, okay, throwing a lot of money at sales and marketing is maybe less efficient, and really think about the foundations and the unit economics of the business, start there and then scale. It's a little bit of a different story, and the order of operations is quite different.
Right, right. But Guillermo, you're actually on the ground operating.
On the other side.
Yeah. And so
I'm in the arena.
Right. I mean, you guys are not, they're not an investor of Guillermo's company, but I'm sure you heard similar kinds of things. And from your perspective, when that message changed and you're being kind of asked, I mean, there's kind of a contradictory dynamic going on here. How do you fix that when they're telling you, okay, you need to do this and this, but don't do that too much?
I fully embraced it. So for context, I run and I started Versel, which is an infrastructure company that essentially makes developers more productive, which is very handy to have in this environment. And we host and serve websites and web applications at scale. We also created a framework called Next.js, which is open source, which is also very good in this environment for companies to adopt. And the reason that I embraced a lot of the changes that have been happening over the past few years is that the beautiful thing about software, the beautiful thing about the web and the internet is that you can naturally be very efficient, right? You produce a great application and you deploy it on a platform that scales, and now the sort of marginal cost of attracting the next visitor and serving that is basically close to zero. So you can have a small team of great R&D practitioners that deploy to the cloud where a lot of the infrastructure has already been figured out for you, and there's constant innovation, and you can scale in a very efficient way. So I think when the tone of the market changed towards do less, but do less better, I think that's how you can sort of marry the idea of spending less, but still growing. Because if you're, what I would look at is a lot of startups that were punching above their weight, too many products, too many concurrent initiatives, maybe too much DIY. So something that's certainly benefited us. So to give you some context, a lot of innovators come to build on Versel. That meant that during the, let's call it the high zero interest rate times, we had a lot of Web3 companies, crypto companies, blockchain companies as customers. And when the euphoria sort of come down a bit in that market, when Jill stopped investing in so many Bored Apes NFT companies, we did see a contraction in certain markets. But at the same time, we saw new opportunities now with companies in AI or companies that were looking to do less. They were saying, okay, I was doing all this DIY infrastructure, I had all these platform engineers, maybe it was scattered across 3-4 different clouds. Now I want to simplify, I want to consolidate, I want to offload the non-critical and differentiated work. So it ended up being a positive for our business. And of course, it's been, with the positives have come some challenges and new opportunities, but I think overall it's been a really healthy thing for the environment and for the ecosystem.
So you touched upon two things. One was the impact on your customers and what you produce and how that kind of helps them control costs, but also you touched upon how your kind of development methodology allowed you to stay lean. Can you dig into that a little bit?
Yeah, internally we call it more wood behind fewer arrows. So how can we focus our product initiatives? How can we say no to features that just seem opportunistic? We were just talking about, there were a lot of successful companies that were going into adjacencies in the market that you would kind of like scratch your head. You were saying, like, why is company X entering market Y? And it's because, to Jill's point, when there's just so much capital pursuing high growth opportunities in successful brands and successful companies, you can be tempted to do more. You can be tempted to go to adjacencies beyond your core capability. So for us, the answer has always been to root ourselves on what we do best. And then when we can spend our innovation tokens in a very judicious way. For us right now, our innovation tokens are going towards AI. The self-serve tier on Versel, I recently shared on X, formerly Twitter, that AI has become the leading reason that new web developers join our platform. So folks are saying, I want to develop AI native products. We're also developing our own AI native products. That's where our innovation tokens go, and they don't go to crazy adjacencies, of which there's so many and so many tempting ones that we could be going after.
So we were talking about AI backstage, and AI has kind of an interesting dynamic because on one hand it can be super expensive, but on the other hand it can drive efficiency in a way that nothing else can. So how can companies use AI without overspending, and particularly startups?
Yeah.
Use AI to their advantage to kind of reduce overhead costs while not falling into that trap of chasing money?
Yeah, I mean, I think AI is a really interesting one because you can sort of apply it. You can add a product adjacency that leverages generative AI to make your product even better. That's obviously hitting the revenue side of things. But then also to your point, there's many products that are coming out that are sort of hitting the more of the cost center side of things. And so you can leverage AI to make your customer, we were talking about this backstage, your customer support function a little bit more efficient, your salespeople more efficient. And in that scenario, you're sort of hitting the cost centers of the business, and many times purchasing a product, which might seem counterintuitive.
Correct.
Purchasing that product to then make the folks within each of those organizations and cost centers much more efficient. And so you can kind of see leveraging an AI on both sides hit the bottom line quite cost effectively.
Right, but it can also be super expensive if you're not managing those models efficiently, or you don't have people or products that are doing this well, right?
Totally. I mean, I think that's the most interesting thing about AI right now, which it sort of remains to be seen how the unit economics of using a large language model in your product, either on the cost center side of things or on the revenue side of things, is going to work out. A lot of that depends on things like inference cost or how expensive it is to ping an AI model. So if you incorporate AI into Versel and suddenly it's like doubly as expensive for your users to come in and use the product, and you have to decide then, am I going to pass that cost on to my end customer, or am I going to eat that cost as cost of goods sold? And so it's decisions like that that are quite interesting that I think my own perspective is over time, the inference costs will go down as the architectures of these models get more and more effective.
But it's true that right now, the higher the reasoning power of the model, the more costly it is.
Right.
So you got to make sure that your business model is ready to incorporate AI, right? Because you have to have maybe something that goes into cost of goods sold, but if you have an overactive user of AI, you have to think about the consumption metered way of charging this customer so you kind of keep the AI utilization under control and you're able to scale with your customers' usage of your AI features. So there are a lot of considerations that go into how do I effectively add AI to my product.
So again, there's two aspects to that, right? There's what you're creating in-house and how much that costs to create to give your customers more efficiency to, and how that cost to benefit is going to play out. And then there's the other side of it. Like you may be purchasing AI from, a vendor or something that's built into your vendor's product, and that may make you more efficient so that maybe you don't have to hire as many employees because people can do more with less. How much are you seeing of that?
I not only am seeing that, I'm also in the market for that. So one of the things that we did, instead of pausing hiring, we said, let's be more judicious with hiring. Let's make sure that our bar is calibrated correctly. Let's make sure, crucially, that folks are onboarding very efficiently and they have all the learning and development tools to actually be productive and thrive within the organization. So applying AI to learning and development, applying AI to onboarding, applying AI to increase efficiency with customer support. These are all things that I want to do.
Right.
And a lot of our vendors say they announce at conferences that they're doing AI, but I haven't really seen the AI products actually hit the market and we're ready to buy.
No, we're hearing a lot of announcements for
so
sure.
Everyone's announcing and putting up the conference billboards and whatnot, saying we'll do AI, trust us. So I think this is a great opportunity for innovators or entrepreneurs to actually bring those efficiencies to hit those bottom lines.
But I think it's important to remember that we don't know yet. You can sort of make that decision on. Okay,
I'm betting.
Yeah, you're making a bet exactly. And
the
a lot
ROI
of what we do changes so fast. And a lot of what we do at CapitalG is, we are I would say, super focused, super analytical on a lot of this stuff. And so we'll help a lot of our portfolio companies. Like, I've built illustrative models on, like, based on what I know from a research perspective, how do I think this is likely to pan out in terms of value to your business or how it's going to hit the cost center. And then I can sit down with a bunch of our founders and talk through, like, then if we are to purchase these products on the cost center side or add these products on the revenue side, what's our best guess on how it's likely to impact the business?
I think for the one that's interestingly easy to measure, and I could have never anticipated, is generative code.
Yeah.
The fact that you can make engineers more productive with AI was surprising to me because I thought, well, programming is surely the job that's going to be hardest for AIs to tackle. But it's clear, like I've read now several papers on we can measure down to like percentage points the efficiencies that we're bringing to our engineering workforces. A lot of companies are still holding out because they're worried about code exfiltration, they're worried about IP, they're worried about copyright, they're worried about, is my data being used to train someone else's model? So you have to also balance it with the needs of IT and security, but it's very clear that you can make engineers a lot more productive with AI. It's yet to be seen if the ROI is so easy to measure for other functions.
Right, right. So I saw a report recently from a Berlin-based company called ChartMogul. I don't know if you're familiar with them, but they look at SaaS data, and they compiled a report over 14 years of SaaS data, and they found that speed to revenue correlates to SaaS success. So the fastest a company got to 1 million, to 10 million, to 100 million, was the more likely that that company would be a successful company, both as a private company and maybe eventually as a public company. So if that's true, and then the job of a SaaS company is to grow, how do you tell them that suddenly it's not quite as important?
Totally. It's an interesting, so obviously there's some serious selection bias in that.
Yeah. I mean, I did push back and say, like, that, like, could there be other metrics that we're not measuring? So I will acknowledge that.
Totally. I mean, I think what that's indicative of is, do you have a product that people are willing to pay for? Do you have a product that people are willing to say, like, I need this product, I am willing to dedicate a significant amount of my budget towards this product and I cannot live without it?
Regardless of the economic conditions.
Yes, exactly. It has to be sort of mission critical software. And I think, scaling revenue is obviously exactly indicative of that point. But what's important about that is many of those companies that have done so quite successfully and are in public markets today, if you were to double click on what the actual unit economics of the business look like, because the product is so exceptional and people, again, are sort of like pounding their fists for it, the unit economics of the business look quite good because you don't have to spend quite as much on sales and marketing. It's much more efficient growth. It's either bottoms up. People are sort of referencing it across the organization. It grows virally. And so I would say that's a huge contributor as well that's maybe missing in the headline of that study.
Right. So when you are suddenly being told, like, to control costs versus, spending, like, there was just periods where sales and marketing spend were through the roof, and when we saw, S1s, it would be like, wow, look at their sales and marketing spend, that's crazy. And now you're being told, no, don't do that. So how do you, in particular, like, what levers do you start pulling to?
I think I would agree with the data that company put forward, because what I notice a lot in our ecosystem is you're trying to create a platform, really. You're trying to make customers get invested, to your point, and you want to grow, you want to land, you want to expand, you want to become ubiquitous. So getting fast to 100 million ARR, to me, correlates with I made my presence known within the category that I'm operating in, and that is where the real growth even starts. That's when I can start, if I have a customer like Unity and Nintendo, and I'm starting to put myself in the critical path of these customers, I can be with them for the next 10, 20 years. So we talked a lot earlier about how important it is for companies to position themselves in a mission critical capability now. So it's not, you have to look at the quality of revenue. One of the things that we stopped doing, for example, is we had the customers that would come to us just for support. They would say, can you please give me support? You created the open source tool. And we said, no, it doesn't make sense for us. So going back to your push on, are your investors telling you to stop growing? Absolutely not. I think that you can have efficient growth, and you can start doing fewer things and continue to drive this engine that then will put you in that position for long-term durability in the market. But I think that's the mission of a startup. If a startup is not growing fast, then I think you start questioning yourself, not just the fundraisers that you did the last 2 years, but the last 10.
Right.
The other thing I'd add just is it's important, you mentioned a couple of times, and sort of like shifting the priorities of an investor saying this and then that. I think there's an important message in there, which is like really understanding and picking your investors thoughtfully. And this comes to mind because I think at CapitalG, like we are long-term partners and we oftentimes will start at the Series B and then invest over time in sort of subsequent rounds through IPO. And I think because of that, we sort of always have this long-term orientation on looking at what's going on with macroeconomic conditions, et cetera, and sort of supporting our founders through that entire phase. I think it's a little bit harder when you have folks who are just trying to get you to the next round, and so might say like, grow, so that you can raise capital for the next round, and are maybe less helpful in thinking through like, hey, how do we build a long-term durable business? And so sort of putting your hat on and thinking through like, when I do choose an investor, how do I make sure I'm getting that sort of long-term vision? I
also think quality of revenue, diversity of revenue. So I talked earlier about like, we have companies that are in the Web3 space, we have companies in the AI space, we have companies in e-commerce, media, travel, luxury. So diversity of revenue is something I think sets companies up for success, because in any given downturn, there's things that do really well, there's things that do not so well. So you can still continue to grow fast while, again, pushing against a market that is perhaps not as favorable as it was a few years ago. The other thing I would call out is I pay a lot more attention to my customers and the broader market than investors. It's not that I show up to the board meeting and say like, shut up guys, like we're gonna do X. But I do think it's really important to basically adapt yourself to what the customer is telling you. We certainly adapted the way we pitched because customers were starting to look at consolidation. A lot of customers in e-commerce were looking at cost cutting themselves. So we had to basically emphasize the benefits of our platform that made sense for their business. And those were avenues in which we could still find sustainable growth without overhauling how the machine actually worked.
So if you're looking at things for the long haul, and I mean, I think that's the way you should look at it. If you believe in a company, a couple of years of downturn is not going to change your view of that vision. It may change their ability to, they kind of have to hang on for those 2 years, but your support for them shouldn't alter, because if you believed in the founders and you believed in the vision, you're going to continue to support that. But, I think a lot of people, if we think that maybe the last downturn was, ended in around 2010, right after the 2008 crash, there are founders who have never experienced a downturn.
Totally.
So I mean, people who have a certain kind of life experience know that there are these economic ups and downs. But a lot of people who are in the current, who are currently founders, if they started the company 5 years ago and they're fairly young, may never have experienced a downturn.
Totally.
How do you kind of help them navigate that, knowing that you want to be in there for the long haul and knowing that they may not know what this means?
Yeah, for sure. That's why I love our investment approach. We make super concentrated bets, which means that we have only 50-ish portfolio companies that are active at any given time. And so we are really hands-on with each of those portfolio companies over very different stages of their life cycle. Like the Series B stage is very different than the Series D when you're going out for IPO. And so we end up we actually have a whole growth team that's sort of like dedicated resources to our portfolio companies. Like I said, I was just on with one of our portfolio companies, like helping them build out a financial model that's really responsive to this economic environment, and sort of walking through literally like Excel line by Excel line to understand like, hey, this is how the macroeconomic environment has changed the way we think about anything above cost of goods sold. Here's the way it's changed the way we think about OpEx, and like here's how the next few years might look, and then here's how we would sort of turn things on or off over.
What drives valuation?
Exactly, and really it's kind of the boring stuff, but it's actually quite critical to how you think about business strategic
But I think
decisions.
that people haven't been thinking about the boring stuff, because it was just like, here's a bunch of money, go spend it.
Totally. Well, it's interesting because I would say that there were sort of two camps of investors over the period of 2020 to 2021. There were investors who truly believed that the public market multiples that were sort of like 30 times revenue that we were seeing at that time were going to be sustained because it was fundamentally a new type of software with SaaS that was so much different and so much more valuable. And if you believed that, then it made sense to invest at the valuations that we saw during that time frame. There was another class of investors that sort of believed, hey, this might be a really like blip in the market, and we did this. We studied sort of over time. We looked at 2008, we looked at 2000, and we said like this feels a little bit more like a blip. And so we had a hard time actually really thinking through what are the right investments in that period of sort of euphoria, because we did believe a little bit more that there would be some more of this correction, and we would want to support our companies over the long term through it.
Yeah.
I have an interesting perspective on this because I moved from Argentina to San Francisco in 2008.
Right.
2009.
That was good timing.
I had asked ChatGPT recently, was there a financial crisis at the time? It confirmed indeed there was. And yeah, because I was oblivious to it because the seed funding environment was so exciting at the time. Everyone that I was talking to in SF was building mobile, social, all these new platforms were emerging. So there was this excitement in the air. I look at the current environment and I see the same thing with AI, where again, it's a great time to start something new, and perhaps you're actually better off maybe having some blinders on and not, I think it was Steve Jobs that said like, I didn't have time to read the Wall Street Journal and like calculate like IPO multiples when I was building Apple in the early days. But I think you partner with investors that are looking out for what are the metrics that you need to hit in this environment to raise your subsequent round, to actually set yourself up for success over the long term. So the environment has changed. It would be silly to say like it's just 2021 again or 2020, but I think that there's incredible new opportunities that have come with the downturn, and I think history does rhyme a bit in this case as well.
So every time I get up here, I'm just a little, like time goes at a different speed up here, and we only have less than 5 minutes left. So I had a bunch of other questions I wanted to ask you, but we have to sort of move the conversation along. And one of the things that kind of occurs to me is that, you know, there are lessons learned when you have to go through an experience like this. And I'm wondering what you can take away from this, both as an investor and as an operator, what you can take away when the economy improves. And, you know, maybe money isn't as cheap as it was, because I don't think we're going back to zero, but it's going to be cheaper than it is now, and you'll have more choices. So what will you take in terms of what you learned about how to, you know, communicate about efficiency and how to implement efficiency?
Yeah, it's a great question. I think something we've been thinking a lot about, obviously, is when there's a big change like this, a lot of reflection happens. You know, I think one thing that's important to consider from the investment perspective is the value of patience and the value of sort of like picking with founders who you feel really excited about working with day in and day out. And for us, like I mentioned at CapitalG, we tend to be more sort of on the analytical side. Like we go very deep in sectors and we work with our founders over a long period of time. What we've realized through a correction like this is we love working with founders who are ready to get sort of down with us, look at the Excel spreadsheets, think through like, okay, if the market environment were to change in this way, how would we change the strategic direction of the business, et cetera? And you know, if a founder is less excited about doing something like that, that's a good indication that like maybe that's not a great fit. You know, we're more excited about working with someone who's like really wants to partner with us, really is excited about our guidance, and really is excited about working together over a long period of time. And I think in the sort of stages of like 2020 to 2021, it's easy to forget that because things are moving so fast and people are raising at, you know, crazy speeds. And so I think our reflection was sort of like, hey, stick to what we know, stick to the types of founders that we work really well with, and continue. We're going to see these cycles if we back companies for 8 to 10 years, and so just continue to stay strong with what we know we do well.
And those founders that learn how to, for the first time, dig into the Excel spreadsheet, they're going to take those lessons with them, and they're probably going to be better founders, right?
Totally, exactly. And it's sometimes you have to go through things like this to really understand a lot of those dynamics.
So how about you? What do you think?
Very similar. The lesson for me is to continue to optimistically focus on what's going to be true 10 years from now. If I can think in that time horizon and then have partners that can meet you there and support you for the long term, I think that's where the magic happens, because if I think back from 10 years from now, I think consumers will be demanding great digital products. Companies are upgrading themselves to become digital native companies and will continue to spend and invest in delivering great digital experiences for their customers. Companies will continue to invest in developers, making them happy, making them more productive. Will invest in AI. AI is here to stay. So focusing on those long-term trajectories, it's very hard to predict what the market's going to do next week. But it's actually quite easy to predict what's going to be true 10 years from now. So I think staying focused on that and then being able to weather the storm, so to speak, and be very adaptive and dynamic in how do we approach the day-to-day, week-to-week, I think that's a big lesson in how to run any good business.
So one last question, which we have to answer pretty quickly. What qualities are different, in the startup founder, when you have all this money to spend versus when you don't have all this money to spend and you have to think differently? And are those teachable qualities?
Yeah, it's a good question. I think that patience, decisiveness, and sort of analytical rigor, I think, are quite important in an environment like this. And really, I think it was so easy in the fast-moving environment of 2021 to just sort of to your point, what markets can we enter next, and how can we continue to spend money in XYZ ways? And it was for many companies kind of fine to do that. But I think the founders who really sit down and put a strategic lens and a decisive lens on this is the direction, to your point, we're spending all of our innovation tokens on this one thing, and we've done the sort of analytical work to defend that. That's, I think, where we get really excited.
All right, well, we are exactly 0, so we've got to go. But please give these two a hand. They were great.